Federal Reserve Chair Kevin Warsh has officially abolished forward guidance. The central bank will no longer telegraph its interest rate decisions to Wall Street, removing the safety net that has defined financial markets for over a decade. The immediate result was a violent liquidation in AI hardware. Institutions dumped $60.8 billion worth of Micron stock in a single session, while SanDisk crashed 14.13%. Yet as the hardware sector collapsed, Apple absorbed the shockwaves, climbing to $308.63 as capital fled into defensive safe havens. The central bank's roadmap has vanished. The market is now being forced to reprice risk in real time, sparking a massive liquidity migration away from speculative bets and toward proven cash flow. This bar chart displays the extreme divergence across the four major indices this week, exposing a structural reset as capital rotates rapidly out of speculative tech and into traditional blue chips. The Dow closed at 52,900.07, securing a 1.97% gain. The S&P 500 followed, adding 1.76% to settle at 7,483.24. The Nasdaq managed a 2.11% rise to 25,832.67, driven by mega-cap survivors, while the Russell 2000 slipped 0.46% to 2,996.11. Volatility measures showed a strange calm on the surface. The VIX dropped 12.28% to 16.15, while currency markets saw minor contractions, with the dollar index ticking down to 100.85 and the USD-JPY pair at 161.12. Look at this line graph. The 10-year Treasury yield is the primary macro catalyst for the current pressure on high valuation stocks. Without Fed guidance, it spiked 2.52% to hit 4.48%. Commodities remained resilient against this rising yield. WTI crude held at $68.43, Brent at $71.54. Gold rose 2.44% to $4,137.30, and Bitcoin broke through $61,460, absorbing capital seeking a hedge against fiat uncertainty. Smart money executed a massive flight to safety. Apple recorded $23.1 billion in daily volume, pushing its price from $281.74 to $308.63. Microsoft showed similar resilience, absorbing institutional cash despite heavy sector volatility. Passive rotation drove the Dow up nearly 600 points. Capital poured into healthcare, which gained 2.70%, consumer staples up 2.41%, and utilities rising 2.27%. Institutions are aggressively repositioning into space and defense. While the $75 billion SpaceX IPO created a localized wealth effect for tech insiders, the broader market surge was led by Aerovironment, gaining over 10% after securing a $500 million Army contract that stabilizes revenue through the high rate cycle. Soaring term premiums mathematically force capital out of speculative high-beta hardware. Investors must now seek fortress balance sheets that can generate free cash flow regardless of interest rate volatility. At the Sintra Forum, Fed Chair Kevin Warsh explicitly abolished forward guidance. He established a strict 2% inflation baseline, refusing to provide Wall Street with any hints about a July rate cut. This forces a transition to a purely data-dependent regime. Traders must now price in unhedged interest rate risk themselves, which is why long-term borrowing costs are climbing. This scatterplot illustrates the severe contradiction in the macro data. On one side, the May JOLTS job openings spiked unexpectedly to 7.59 million. On the other, the June ISM Manufacturing Index showed clear signs of economic deceleration. That JOLTS spike directly contradicted the June Nonfarm payrolls, which collapsed. The economy added only 57,000 jobs against an expectation of 100,000. This removes the Fed put from the market. In this new framework, poor economic data no longer acts as a buy signal for tech based on hopes of a rate cut. Instead, it serves as a warning of recession risk, making high-valuation tech an unhedged liability. In Washington, Supreme Court rulings struck down restrictions on birthright citizenship, securing labor supply for industrial sectors. A separate ruling shielded the Federal Reserve from presidential firing power. reinforcing central bank independence and supporting hard money assets like Bitcoin. Compounding these internal dynamics are escalating geopolitical risks. Threats of USMCA tariffs threaten North American supply chains, while suspended negotiations with Iran and Syrian diplomatic moves keep Middle East risk premiums elevated. Contradictory macro data, combined with zero central bank guidance, creates a toxic environment for growth stocks. This is the structural trigger for the rotation into defensive value. The week's extreme rotations can be traced across 4 specific days. On Monday, June 29th, Comcast announced the split of NBC Universal and Sky. The stock jumped 6.7%, triggering a 3.11% sector-wide communications rally as investors chased value unlocks. On Tuesday, June 30, the FTC approved Elon Musk's acquisition of Mesh Optical. By validating 1.6 terabits per second space edge compute, the news triggered a 12.76% short squeeze in the SOXL semiconductor ETF. Wednesday, July 1st reversed that momentum. Meta entered the AI cloud space, jumping 8.81%. The threat of downstream margin compression sparked a panic that crashed upstream suppliers Micron and SanDisk by over 10%. Finally, on Thursday, July 2nd, the severe 57,000 Nonfarm payroll miss combined with news of a Singapore chip smuggling raid. Defensive panic set in, pushing the Dow up nearly 600 points. In 4 days, the narrative deteriorated from telecom optimism to space tech euphoria, ending in a brutal purge of AI hardware valuations. This matrix chart outlines the bull, base, and bear cases for the week ahead. We are watching the 50-day moving average on the SOXX ETF particularly closely. Because trend-following CTA quantitative funds use this level to determine momentum, a break below it would trigger automated sell orders, potentially accelerating a move lower regardless of corporate earnings. For the Dow, currently at 52,900, a bull break above 53,500 requires Treasury yields to fall below 4.30%. The base case is a tight 52,000 to 53,100 range. The bear scenario triggers below 51,200 if USMCA threats spark stagflation bears. The S&P 500 sits at 7,483. A bull challenge of 7,600 needs the VIX suppressed below 15. The base scenario holds between 7,350 and 7,520. A bear breakdown below 7,280 occurs if the Magnificent Seven lose their technical support. The Nasdaq closed at 25,832. Reclaiming the 26,500 bull level relies on NVIDIA successfully lobbying to ease export restrictions. The base case ranges from 25,400 to 26,100, while a bear drop below 25,000 will be driven by compliance margin calls. Index performance for the next quarter is dictated entirely by yield thresholds and technical defense lines. The Federal Reserve will not rescue over-leveraged positions. In a high-yield environment, capital is diversifying. While gold and cash provide a floor, the most significant institutional repositioning is targeting 2 areas: software monopolies with deep cash reserves and defense oligopolies with guaranteed government contracts. This candlestick chart for Apple maps our first tactical deployment. Their closed ecosystem provides monopoly pricing power in edge AI, allowing them to easily pass rising hardware and compute costs directly to consumers. Wait for a pullback from the $308.63 close to an entry zone between $289.15 and $294. The stop loss is strict at $270, targeting a valuation expansion to $340. Next, this chart tracks Microsoft. They function as an enterprise software tax collector. As the job market cools, companies will rely on Microsoft's AI tools to automate workflows and reduce headcount, making the stock highly defensive. Target an entry at the 50-day moving average between $373.14 and $378.87. Set a stop loss below technical support at $349, with a macro target of $440. Finally, this chart highlights Aerovironment. They just posted a massive Q4 revenue beat of $641,600,000 and secured a $500 million Army contract. A $120 million funded backlog completely shields them from high corporate borrowing rates. Let the post-earnings gap settle. Wait for a pullback from $190.98 to a $176.06 entry. Place a strict stop loss at $155, targeting a return to the 200-day moving average at $254.60. In a data-dependent, high-yield environment, surviving volatility means aggressively anchoring your portfolio to cash-rich tech fortresses and government-backed defense spending. For more deep-dive U.S. stock and market analysis, remember to like, subscribe, and share Calling Monster Finance.